Welcome back to Trading Hour. Well, Maneesh Dangi, CEO and founder at Mosaic Asset Management, joins us now to discuss market fundamentals and his top sectoral picks. Thank you so much, Maneesh, for joining us. Well, at the current juncture, what are you making of the markets? There's been significant price correction. Any sectors you find attractive at current levels?
So if I'm more of a macro trader and actually trade beta instead of micro of it. In general, I think markets have sort of down corrected a bit, but I think the pain is still out there. You still have 6-8 months of listless in the best case scenario, and perhaps sort of even more downturn from here. So that's a big picture macro story. What I don't like, of course, is anything to do with what China makes well or US imports. I think those are the sectors which are going to get hurt sort of pretty significantly. Given that the Indian cyclical downturn is not very deep, anything to do with India consumption at margin, is where you should sort of begin to dial up. Finally, the next bull market, as it always happens, is led by BFSI, most importantly, banking. So, we've had sort of stresses, in very, very small financiers like microfinance, moved into mid-sized banks, and now at some point in time will enter into large-sized banks. So I think from a sequencing point of view, the incremental beta should be dialed in through financiers. So that's a big picture view of how I would dial up risk at margin in markets now.
Maneesh, let's talk about the global markets and economies at large. Now, US economy, do you think it's likely to get into a recession this year? There is talk about stagflation. Last week, we were talking about stagflation. This week, we're talking about recession. But, I mean, the US exceptionalism, right, is being questioned now. The AI dominance is now being challenged by Chinese makers. Some of the economic indicators are flashing warning signs. So what is your expectation of how US economy is likely to perform in the next 12 months and what it means for Fed rate cuts?
So in US, there are a couple of things. One, of course, in US, a little bit of a self-inflicted wound. Between DOGE and tariff, they didn't have to do it, and yet they're in some sense as if imposing austerity on themselves, and it's an active policy, so to say, to achieve something, and which that something is a little bit of a, I guess a policy shift in US. Of course, the side effect of that will be slower economy. So far, US is sort of pretty steady. I kind of thought 6 months ago that, US would enter in, significant slowdown by now, but hasn't happened. So, but to a certain extent, between DOGE and tariff, it's likely that in the next 6-8 months, US actually sort of very, very sharply slow down. That's one. But from a pure market standpoint, US has sort of other problems. One, pretty much like 2022, you are starting to see earnings roll over there in the tech market particularly. And so both investments are taking a hit there at margin. At least 4 or 5 months, if you're watching US tech earnings, they're starting to roll over. So I think that's going to be a bad news. And on top of it, as you said, China is clearly threatening US's hegemony in tech. And so to that extent, this exceptionalism, and US exceptionalism, by the way, has been mostly about techs, since 2006-07. I think that's getting threatened. So in some sense, if you were to sort of look at one market which perhaps is sort of most overvalued and is likely to get threatened most significantly, both from a fundamental standpoint, but also from the point of view that, there's been a huge positioning, I think that's the US market. And, I kind of called it out about a fortnight ago across many channels that, US is a market, you should be sort of super wary of and, exit risk as much as you can there.
So, Maneesh, Indian equities were the only game in town, and now everyone's talking about how asset allocation. So if all options are open on the table, it's not for Indian equity investors, etc., people who are watching predominantly, but still, if all options were on the table, which asset class is now best placed? Give us your pecking order.
Sort of as a top-down asset allocator or macro allocator, you sort of first look at territories. So, of course, US is a market, at least personally I've been sort of overweight on because it's primarily a US dollar call. But at margin, of course, as I said, that looks the most fragile market. You really can't do big bets or position sizing in China and Europe. But almost certainly, Europe seems to have woken up. They seem to have sort of, turned back to sort of more defense spending, higher fiscal deficit. Of course, that means Europe most probably will not be sort of weaker forever, will begin to strengthen. And of course, bonds are taking a hit there. So I guess, Europe is a small market, that you could do a little bit of a position sizing. China, again, moves sort of from one extreme to another, from sort of a darling of the market to, non-investable market. But again, small positioning there. But for a local investors, I understand that, mostly it's going to be a call between fixed income versus equity. And I made this point to you since last September, October, that, it's likely that for 3-4 years, bonds, simple bonds, fixed deposits will likely earn more than equity. So I don't sort of want to change that view yet. I think, Indian markets are still sort of fragile. I think the positionings are very, very strong. Margins still have to roll over. And the scarrings of last 6-8 months will stay. So I think it's going to remain a sell on sort of rally instead of buy on dip market for at least 6 to 12 months time.
Thank you so much, Maneesh, for joining us and giving us your view as far as various asset classes are concerned. Well, time now for a short break. Parag Thakkar from Fort Capital joins us next to discuss the latest trends from banking sector and the developments related to IndusInd Bank.